Many business owners think about taxes only when the filing deadline is approaching. By that point, most opportunities to legally reduce taxes have already disappeared. Effective tax planning begins on the very first day of the financial year, not during the final few weeks before filing a return. Tax planning is the process of organizing business decisions in a way that legally minimizes tax liability while keeping the business fully compliant with federal, state, and local tax laws. It is not about hiding income, creating fake expenses, or finding loopholes that could create legal problems later. Instead, it is about making smarter financial decisions throughout the year. Imagine a small consulting company that expects to earn approximately $300,000 during the year. The owner waits until March to think about taxes and discovers a large tax bill. Another consulting company with nearly identical revenue starts planning in January. The owner tracks deductible expenses every month, contributes to a retirement plan, purchases necessary equipment before year-end when appropriate, maintains organized financial records, and works with a qualified tax professional throughout the year. Even though both businesses generate similar income, the second company legally pays less in taxes because every financial decision was made with tax efficiency in mind. This illustrates an important principle that every business owner should remember. Taxes are influenced by decisions made every day, not only by what happens during tax season. Good tax planning also improves cash flow because owners are less likely to face unexpected tax bills that strain business finances. Instead of scrambling to find money when taxes are due, they already know what to expect and have prepared for it. This creates stability, reduces stress, and allows management to focus on growing the business rather than reacting to financial surprises. Knowing your business structure can save thousands. One of the biggest tax planning decisions a business owner makes often happens before the first sale is ever completed. Choosing the right legal structure can significantly affect how much tax a business pays and how profits are reported. Many entrepreneurs select a business structure because it seems simple without understanding the long-term tax consequences. A sole proprietorship, partnership, limited liability company, S corporation, and C corporation each follow different tax rules. The best choice depends on revenue, profitability, growth plans, payroll strategy, ownership, and future investment goals. Consider two businesses that each earn $250,000 in annual profit. One operates as a sole proprietorship, while the other has elected a different tax treatment that better matches its financial situation. The second business may qualify for tax advantages that reduce overall tax liability while remaining completely legal. However, those benefits only exist because the owner reviewed the business structure before growth accelerated. Business owners should understand that selecting a legal entity is not simply a legal decision. It is also a financial strategy that influences payroll taxes, self-employment taxes, deductions, retirement contributions, and how profits are distributed. As businesses grow, the structure that once made sense may no longer be the most tax-efficient option. Reviewing the entity with a certified public accountant or tax advisor every few years can identify opportunities to improve tax efficiency without changing daily operations. Tax planning is not about finding one perfect structure forever. It is about ensuring that the business structure continues supporting financial goals as revenue, employees, customers, and investments expand over time. Owners who regularly review this decision often avoid paying unnecessary taxes while positioning their companies for healthier long-term growth. Tracking deductible expenses the right way. A smart tax plan depends on accurate expense tracking. Many business owners lose deductions simply because they do not record expenses properly during the year. A deductible business expense is usually something ordinary and necessary for operating the business, such as software, office supplies, advertising, professional services, business insurance, payment processing fees, travel, training, and equipment, but the expense must be clearly connected to business activity. For example, if a business owner spends $12,000 on marketing during the year but only has receipts for $7,000, the business may struggle to support the full deduction if records are questioned. Good tax planning means keeping clean documentation before there is a problem. Owners should separate business and personal accounts, save receipts digitally, categorize transactions monthly, and review expenses before year-end. This habit does more than reduce tax stress. It helps owners understand where money is going and which costs are actually supporting profit. Poor expense tracking can make a profitable business look confusing, messy, and risky. Strong tracking creates financial clarity. It also helps the tax professional identify deductions that may otherwise be missed. The goal is not to spend money just to get a deduction. Spending $1 to save a smaller amount in taxes is not automatically smart. The real goal is to properly deduct expenses the business already needs. When owners treat bookkeeping as part of tax planning, they protect cash flow, reduce filing mistakes, and make better decisions throughout the year. Planning for estimated taxes and cash flow. Many small business owners in the United States are surprised when they learn that taxes are not always paid only once per year. Depending on the business structure and income level, owners may need to make estimated tax payments during the year. This is where tax planning becomes directly connected to cash flow management. If a business earns strong profit but does not set aside money for taxes, the owner may feel successful during the year and then panic when the tax bill arrives. For example, a service business that earns $120,000 in profit cannot safely treat the full amount as spendable cash. A portion may need to be reserved for federal income tax, self-employment tax, state tax, and possibly local taxes. A smart owner creates a tax savings account and transfers a percentage of profit into it every month. This simple habit prevents tax deadlines from becoming financial emergencies. Estimated tax planning also helps owners avoid unnecessary penalties and interest. The exact amount depends on income, deductions, credits, prior year tax, and business structure, so professional guidance is important. However, the principle is simple. Taxes should be planned like payroll, rent, inventory, and loan payments. They are not optional surprises. When owners forecast taxes early, they can price services better, control spending, and make investment decisions with confidence. A business that plans for taxes throughout the year feels more stable because the owner knows how much cash is truly available after tax obligations are considered. Using retirement plans and tax credits to reduce taxes legally. One of the most overlooked tax planning opportunities for business owners is combining retirement planning with available business tax credits. Many entrepreneurs focus only on deductions while ignoring other legal strategies that can significantly reduce their overall tax burden. Contributing to a qualified retirement plan can lower taxable income while helping the owner build long-term financial security. Depending on the business structure and individual circumstances, retirement contributions may provide meaningful tax advantages. At the same time, business owners should understand the difference between a tax deduction and a tax credit. A deduction reduces the amount of income that is taxed, while a tax credit directly reduces the amount of tax owed. This distinction can make a major financial difference. Imagine a business that invests in qualifying activities or improvements that are eligible for tax credits. Those credits may reduce the final tax bill dollar for dollar, making them especially valuable. Business owners should also stay informed about federal and state tax incentives that encourage activities such as hiring employees, improving energy efficiency, investing in research, or offering retirement benefits. These opportunities change over time, which is why regular communication with a qualified tax professional is essential. Waiting until tax season often means missing deadlines or planning opportunities that could have been used months earlier. Smart owners review potential credits and retirement strategies before making major financial decisions. Tax planning works best when every important investment is evaluated not only for its business value, but also for its tax impact. By combining long-term retirement planning with legally available tax credits, business owners can strengthen both their company's financial position and their personal financial future. Building a year-round tax planning system. The biggest mistake many business owners make is treating tax planning as an annual event instead of an ongoing business process. Successful companies build systems that support tax efficiency every month of the year. A year-round tax planning system begins with accurate bookkeeping, monthly financial statement reviews, regular cash flow analysis, organized documentation, and scheduled meetings with a certified public accountant or tax advisor before major business decisions are made. Instead of reacting to tax bills, owners proactively evaluate purchases, hiring decisions, equipment investments, financing options, and profit distribution strategies from both a business and tax perspective. Imagine two businesses that each generate $1 million in annual revenue. The first owner reviews financial reports only once each year during tax season. The second owner reviews profit and loss statements every month, monitors estimated taxes each quarter, adjusts financial strategies as business conditions change, and discusses future plans with a trusted tax advisor throughout the year. Although both companies earn similar revenue, the second business is far more likely to preserve cash, reduce unnecessary taxes, avoid penalties, and make better financial decisions. This is the true purpose of business tax planning. It is not about finding shortcuts or avoiding taxes. It is about creating a disciplined financial system that supports compliance, improves cash flow, reduces uncertainty, and allows the business to grow with confidence. When tax planning becomes part of everyday financial management rather than a last-minute task, owners gain greater control over their finances, make more informed decisions, and build businesses that remain financially healthy for many years. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.